Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
ARM Holdings shares tumbled around 8% after the chip designer gave what was termed a lukewarm revenue forecast. And what we say in our story is that this could raise concerns that AI spending is slowing. And we're joined here by Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst, on the earnings. So we got a couple of things going there, the broader market and then ARM itself. First of all, did you read the forecast as somewhat lukewarm?
I did, and the thing here is, though, we don't think the AI story for ARM had significant impact here. The likely drivers of sort of the miss versus what the street had were coming from networking and industrial IoT, which are not the AI markets. And this weakness has been very publicly, it has been visible across all other semiconductor companies coming into this earnings. So this is something, market-driven, not AI specific to ARM.
So when you look at their exposure to the the smartphone industry, I mean, how does that look to you, Kunjan?
Look, again, the long-term story remains intact. Their percentage share of their V9 architecture, which have doubled the royalty versus the prior gen, continues to go up each quarter, growing 5% as a total percentage of royalties every quarter, which we think will continue. And the biggest beneficiary that penetration coming from the smartphone markets. So most of the premium, in fact, almost 100% of the premium smartphones run on ARM architecture. And that is the segment that is seeing relatively robust strength over the rest of the smartphone market. So they're really benefiting that. The unit growth is slowing, yes, but they are getting corresponding ASP increases, again, due to higher royalties there.
So the reason I asked you whether or not the revenue forecast was lukewarm was that it was beyond the midpoint. It just wasn't over the high end of the range that they gave. So, I think some people would say, well, it was sort of within the range. But we have to say that the stock maybe is not the best way to read really the health of the company, because the stock was already up 41% this year. Falling 8 or 9%, is not the end of the world, is it?
No, you exactly got it right. Look, it was not that bad of a miss. What you have going is a combination of two things. Like you said, what we have seen this earnings season, these high-flying AI stocks who have benefited and from rich multiples because of their AI story have just been priced for perfection, where every quarter investors are setting up high expectations of significant beats and raises. And when that meets reality, which was, again, not AI-driven, this is what you are seeing in terms of stock reaction, bringing them slightly back to earth and back close to reality.
So we know that ARM is roughly 90% owned by SoftBank, and we had news tonight that SoftBank is in talks now to acquire this British chip startup called Graphcore. Do you know anything about Graphcore? And then kind of give us a sense of what's going on with SoftBank as it relates to semiconductors.
I don't cover Graphcore, so I might not be the most smartest person to talk about it. I can just quickly allude to it is one of, Graphcore is an AI sort of chip or a massive chip manufacturing company. And it would make sense, right? SoftBank always is looking to invest in the next sort of gen AI, whether it's some semiconductors or hardware company. So that aligned with that strategy, that makes sense.
ARM has something of an unusual role in the semiconductor industry in that it licenses instructions that software uses to communicate with chips. Walk us through a little bit about what makes ARM unique.
Yeah, what makes it unique is it has this unique position within the industry where almost every player needs ARM and it has a friendly relationship, which is not what you see across the board. Like, give you an example, most of the semiconductor companies use ARM's IP. So they are their customers, and they prefer ARM. That's good for ARM. Most of these semiconductor companies' customers, which are your cloud guys, your hyperscalers, also are ARM's customers. So it has this. It enjoys this really friendly sort of neutral position within the ecosystem, which no other company has. And to be honest, in a lot of markets, there is no other option. Like, for example, smartphones, they have 100% share. When you think about anything not x86 architecture, whether it's in PCs, whether it's in server CPU, there's only one name almost, which is ARM. So it just has this really good, unique positioning across the ecosystem.
Do you think that there is still a little bit, I don't want to say market excess, but maybe a little too much enthusiasm when it comes to semiconductors vis-a-vis artificial intelligence? Or do you think the market has it about right?
I think from a fundamental perspective, most of the estimates, the market has it right. I can't speak to valuation because here at Bloomberg Intelligence, we don't give price targets. So I leave that up to it if the market has it right when it comes to the richness of the multiples that some of these names are trading at.
Kunjan, thanks so much for joining us. Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst, taking a closer look at ARM earnings. Well, China's trade data for April are likely to show exports and imports swinging back to year-on-year increases after being negative in the last print. Joining us now is Eric Ju, Bloomberg Economist, on China and Hong Kong. Eric, why? Why do we swing back to positive?
I think so far this year we have seen some improving signs on export, and March was actually, probably a one-off blip because we had a very strong growth in the March last year. So that's a very challenging base effect. So we saw a drop in the exports last month, but I think now the base effect will be more favorable for April. And usually on seasonal, factors, April would typically, pick up slightly from March. So both factors will support a better headline in April, and we would expect to see a small increase year on year. So in this year's outbound shipment.
So when you look at exports, Eric, there are two components in my mind. One is kind of the overall global economy and the extent to which there's strong external demand. And in the case of China right now, it's though it's been struggling with a weak currency. When you're dealing with an export part of the economy, a weak currency is going to be a big benefit, right?
It's some benefit, but I won't say it's a big benefit because I think even from policymakers' view, I think that the fundamental thing driving export was still the external demand. It's not really the currency issue, unless you have a big depreciation in yuan. But I think it's marginally it's going to help, but I think it's not the fundamental driver.
We saw a big jump in South Korea's exports, right?
Yeah.
Does that sort of presage what's happening here?
Yeah, but you have to remember South Korea, it's kind of different in terms structure of the exports. For South Korea, it's more on the chips. I think their strength this year is more driven by a big rebound in the chip shipment. But I think China is a more broad, a goods basket. So I think it's more depending on the overall, a stabilization of the manufacturing demand.
So when we look at Chinese imports, how is domestic demand right now?
I think if you look at imports so far this year, it's still so-so. So we haven't seen a very clear sign that domestic demand is picking up. So we still expect a small year-on-year increase in imports in April. But overall, we will say we haven't seen a very good sign of some turning point in the domestic demand. I think that's still something is confusing the policymakers. They have to do more, to try to stimulate domestic demand.
We've heard a lot from the United States and from Europe about overcapacity in various industries in China. Yeah. I'm interested in your take on that and the impact that it has on, say, the domestic economy.
Yeah, and I think for this question, I think there are two sides, both arguments. I think, but from economist view, I think sometimes it's not really about overcapacity because right, it's just a free trade that's a 200 years old economic theory, right? It's not like every country producing based on your domestic demand, right? Because we have a free trade world, so if there's a demand outside your country, so that doesn't mean you cannot produce. You still can produce.
Well, I hear what you're saying, although we just were talking about this new move from the government in China, new rules drafted it, slowing the expansion of the domestic battery industry. So, I mean, I hear what you're saying in terms of free trade, but are there perhaps segments of the manufacturing economy in China that have a strong issue here when it comes to overcapacity?
Yeah, I think it's sometimes it's also, even look at within China, there could be some overcapacity problem, EV or batteries, because I heard from industry that the domestic demand for electric vehicle is really, it's close to full. So every producer are trying to go outside because there's no much more demand, new demand left in China. So I think in terms of that, you can say, yeah, we are producing more than what domestic consumers can buy, but there's still a big, huge overseas market. But the thing is now they face more and more trade, probably frictions on that front.
Yeah, the reason I asked you just briefly is that I wonder whether or not it kind of adds to deflationary considerations when you overproduce at home.
Yeah, it's but I think the deflationary story. I think we did look at the inflation data. We decompose it into supply or demand factors. I think since the second half of this year, the weak inflation was still mostly driven by the weak demand side. It's not supply side. So I think it's still for China. It's the main reason is still people are not willing to spend. The consumption is too weak. Yeah.
Thanks very much for joining us here in our studios. Eric Ju, Bloomberg Economist covering China and Hong Kong. Joining us now on the program is Julia Wang, Executive Director and Global Market Strategist at JPMorgan Private Bank. Julia, thanks very much for coming into our studios. So we're in a bull market. It would take a brave person, I suppose, to say, well, it's over now. We're going the other direction. But I put this question to you. Are traders at the moment, are we seeing from the caution in markets, are they driven more by FOMO than they are about having confidence in the fundamentals?
Well, I think that if you think about the incredible gains for the equity market in the U.S. and also some parts of the world since basically late last year, it's been many markets were up 10-20% over the last 3-4 months. So I think that it was natural, almost expected, a healthy adjustment as we had into April to see a pullback in risk sentiment. We saw some rebalancing of flows. We saw some investors adjusting their positions here and there just to make sure they're not overly attached to one sector or one theme. But we do think that the fundamental thesis for equities have not really changed, and they're still quite positive. You talked about the Fed. The Fed is, maybe they're not going to cut so soon, but they're not hiking. Right, the direction of monetary policy still unchanged. So that factor is still there. And then you have the structural changes in the global economy, artificial intelligence. I mean, you can debate the speed and who's going to win, who's going to lose, but the structural change is there. So we still think that, and of course, the economy globally, particularly in the U.S., continue to hold up. And the rest of the world is a little bit softer, but it's not quite recessionary. So we do think that the overall macro backdrop is still there, and that's why we do think that the risk asset equity market in particular will probably recover from this consolidation phase.
Julia, can we talk a little bit about what's happening to the Chinese equity markets? I mean, this has been a pretty remarkable recovery so far this year. How are you reading this? What do you understand it's about?
So we think it's a tactical recovery from an oversold position. So if you think about coming to the year, Chinese market were down. Hong Kong market was down to nearly below 15,000 in late January when the rest of the world was powering ahead. And of course, then that investors were after 3 months of very strong gains in the U.S. and the rest of the world, investors wanted to take some position away to diversify. And China, in the meantime, did not fall further because the economy seems like it was holding up, even though we debate the sustainability of that. So I think that led to a return of flows to this part of the world, which is one of the reasons, alongside undemanding valuation, that drove a recovery in markets. So we do agree that the recovery probably was overdue. It was an oversold market in January, but we do think that fundamentally the economy still does face challenges. There's still uncertainty ahead. So we do think that it's probably the rally. Probably most of that probably already happened, and that's where we are.
So it's not on your conviction call list. You're talking about buying on the dip in Japanese equities and U.S. equities as well, and then, as you already talked about, some of the secular themes like artificial intelligence and semiconductors. Let's pivot quickly to Japan. Although actually, let me ask you about Hong Kong first, and then perhaps we can pivot if Doug is willing. There was an interesting story that we looked at today that's tied to a conference that is actually today that Hong Kong is organizing. Hong Kong Exchanges and Clearing is organizing with the Saudi Tadawul Group. And they're looking for, some extra support for the Hong Kong market. Do you see Hong Kong as having the ability perhaps to move ahead if China doesn't?
I think from an economic cycle perspective, is increasingly tied to China's economic cycle. So I think that, but I do think from a market structure perspective, there are all these longer term adjustments that the regulators here can make that will further make the market more resilient. I do think that these are, however, quite long term, and they're probably not the factor that really explain why the market rebounded the way it did. I do think that to see a more sustained recovery in the market in this part of the world, you do need to see a turnaround in China's growth outlook or a clarity or turnaround in China's policy direction. And neither of these two things have really changed at this point.
Before we get to Japan, and we'll get there in a moment, I want to talk about the earnings that we're likely to get next week. Big names out of China: Tencent, Alibaba, JD.com, Baidu. What is your sense of what we're likely to get next week?
So I'm not an equity expert by far, but I think that from what we can see from a broad perspective, I do think that investors' sentiment towards big tech in China has already warmed quite a bit. Particularly, you mentioned Tencent, all these big names. There are things that we know, like gaming, for example. The regulatory process worked a little better, so all of that gradually has dripped through to markets and probably are in the price at this point. So we do think that earnings, of course, are important, but we do need to see a sustained turnaround in their guidance for the next few years for the market to do even better from where it is today.
Okay, to Japan, we do have a little bit of a mix in the market. I've heard recently a few commentators saying that they don't really buy into, the structural reforms and the whole bull market story on Japan, that, they've made all these improvements and such. Others are sticking with that and see a lot of potential for the Japanese market going forward. Your thoughts there?
Yeah, so I think that there are two big structural changes. One is actually what's happened in the global economy, the global supply chain shift, the arrival of AI. And as I said earlier, we can debate the pace of it, but it probably is a secular change that will be with us for the next 5, 10, half or even a decade. So that's one thing that Japan industry is just in a position to benefit from. They didn't create this, but they're on the supply chain, they're monopolies, they can benefit from it. The second thing is we do think the reflation story is taking hold. There is a rise in household and business expectation for prices and wage growth for the first time in 30 years. You can see that in the range of data. So I think that this will take time to play out. It's not a one night or even 1 year story, but the move away from reflation seems real. So for these two reasons, both of which are very structural and are not so tied with the day-to-day move in the FX market or risk sentiment, we do think that Japan is an investable market again for 30 years, and that's a very different position from where it was in last decade. So globally, investors have been so underweight this market, but suddenly it's investable. So we think that this is the real shift that's happening.
Julia, how do you understand the reliance that Japan has on a strong Chinese economy? Is that still the case right now?
So if you look at bilateral trade, China is still the biggest trade partner for Japan. Japan is maybe third or fifth biggest trade partner for China. So bilateral trade is strong, and China imports a lot of robotics and high-end equipment from Japan. And while China has this long-term goal to be self-sufficient and move up the value chain, in the process through which they get there, they rely a lot on Japanese technologies and businesses. So I think that the ties will stay. And that is actually a small positive for Japan as well, because that's an area of demand that they will see for the next couple of years.
So if we really boil it down with what's happening in China, is it safe to say that we've seen a cyclical upturn, but we still have secular headwinds?
That's one way to put it. I think cyclical stability is another way to put it. In a sense, the stability allows investors to take the tail risk off the table, or at least reduce the probability of that happening. Together with what's happening globally with the diversification of flows is what I think drove the market recovery. But we think that the concerns, next 6 to 12 months are, housing market is still declining by a sharp rate every month, and there is a constraint on what policymakers can do on a stimulus front. All of these are still concerns.
All right, Julia, thanks very much for joining us. Julia Wang, Executive Director, Global Market Strategist at JPMorgan Private Bank.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.